Okay. Awesome. We are live. My name is Andrew Wall. I'm the managing partner here at CPA for IT, and I'm going to be presenting what can you deduct as a small business owner. Just a little bit of housekeeping before we get started. For those of you who are joining us live here in Zoom, and we did have over 100 people registered for today's session. If you have any questions throughout the webinar, you can fill them in using the Q&A. That's our preferred method, and I'll be checking that regularly as we go through the webinar. And feel free to ask questions as we go. I'll be happy to address them as I see them. If you have another question and you want to actually ask it verbally, you can raise your hand and I will unmute you so you can ask your question verbally. We will also be checking the chat at the end just to see if there's anything we missed, but I won't be checking the chat as we go throughout the webinar. In addition, if you're watching us live on Facebook, then you can still post your questions directly into the Facebook post, and one of my colleagues will do their best to take that question and bring it over into the Zoom so I can answer it live here for you. And of course, if we miss it, we'll come back and circle back to answering those questions for you. Want to also let you guys know that we've got some new tools that we've released in the last couple of weeks. We have a new chat bot that is put on our website at cpa4it.ca. It has been loaded with a complete copy of the Income Tax Act and our entire tax library. So it is very knowledgeable in Canadian tax situations, and it's a great place to go if you have any tax questions to see if AI can answer it for you. Now, keep in mind, it is AI and it's far from perfect. So if you want to meet with your accounting team, don't feel like this is a replacement for them. It's just another tool to make things faster and easier for you. And for those of you who aren't familiar with our organization, as I said earlier, I'm Andrew Wall. I'm the managing partner here at CPA for IT. CPA for IT was initially founded under Wall & Associates by my father, George Wall. We've been in business since 1984, too many years to count. And we've been specializing in service-based businesses the entire time, with our primary niche being IT consultants, but we also service doctors and realtors as well, who face the same issues when it comes to organizing their finances, creating wealth, and transforming wealth into a legacy. We have been recognized with a number of awards over the years: Top 50 Cloud Accountants, Elite QuickBooks Pro Advisor, and we are also an ISO 9001 registered firm, which means we are very system oriented, very structured, and we have external auditors who come in to review our systems and processes to make sure that we're always looking for improvement. And as a programmer myself, I lean heavily into technology, and we're always looking for ways that we can leverage technology to make our process better for you. Without further ado, I'm going to share a little bit of our agenda today, which will be going over how we at CPA for IT add value, a little bit about our process. Then we're going to be talking about our chart of accounts and what a chart of accounts is and why it's important. Then we're going to look at some specific expense accounts, assets accounts, and then finally some additional resources and networking for you. I'll try to move through how we add value in our process as quickly as possible so we can get to the areas that I know you are interested in, which is fundamentally, what can I deduct? But at CPA for IT, our mission is to help our clients organize their finances, create wealth, and transform wealth into a legacy. And over the years, we've developed a number of proprietary products like our audit representation protection, our financial benchmarking analysis that we use to show you how you compare to the average and the median, our proactive strategic planning, which is very unique, the way we do our tax planning for our clients. And it is that time of year. Our next webinar coming up will be on source deductions, and tax planning is an important part of everything that we do, as well as financial quarterbacking and working with your financial advisors. We do also offer business coaching, as well as a whole bunch of webinars and seminars like the one that you see here, and a whole bunch of content that we deliver through various social media channels. And if you're ever looking for a past webinar, you can go to our YouTube channel and you'll find copies of that content there as well. Now, I did want to just have a quick overview of what our process looks like, just to reiterate that for maybe some of you that are new to the organization. But when you bring in your year-end information for us, that kicks off our login process. We're going to take a look at the file, review it, make sure that we've got everything, go back to you with any requests for additional information. We've got everything, we move on to data entry. Once the data entry is complete, we have a working copy that goes in for our first quality control step, which is a review done by the account manager. If he's happy with the quality of the file, he'll let you know that we have a copy of drafts available and send you a link to their Calendly link so you can book a time that suits your schedule. You'll go over that with them, looking at the benchmarking analysis, the financial planning, the pyramid of power, which is the where you are now, where you want to go, and how you're going to get there, financial planning. And then we'll do whatever post-review data entry is required, maybe some adjustments, the sort of finalization and packaging. It does go into a final QA review, and provided everything's good, we release the final package, and then you sign off and we file. So a fairly simple and straightforward process. We will also notify you as your file moves through its journey within our office. So as it moves from stage to stage, you'll get a notification, okay, this file has been promoted to data entry, and the person working on your file is, Sri Vaishnavi or Kanan or whoever might be working on your file. Oh, it's ready for review. It's now with Michael, Satwinder, Andrew, Mubin, or Colin. And so that's the fundamentals of our process. Now, the keys to keeping our process smooth is delivering a set of financials that are easy for us to work with. And one of the most important things that you can do when you're providing your financial information to us is provide your information using our chart of accounts. And for those of you who may not be familiar with what a chart of accounts is and why it's important, we've got a slide to cover that. So a chart of accounts is basically a financial organization tool that provides a complete listing of every account in the general ledger that we're going to use. And chart of accounts can be completely customized business by business. However, in order for us to do a benchmarking analysis, we need to use a standard chart of accounts so that we can compare you to other people and show you how you compare against the average and the median. If we're not using a standardized chart of accounts, then it's really hard for us to be able to show you how you compare to the standard that we have. And it does look like we've got our first question that's come in. So I'm going to take that right now. So submitting files, submitting Lisio files for fiscal year end, how is the best way to submit all files? So the best way is absolutely Lisio. It's the only way that we're taking documents formally now. I guess ostensibly you can email documents, although you should never, ever share anything by email that is confidential or financially sensitive. So we discourage email. Lisio is the way to share and upload your information. You can upload documents as you go, as you sort of build and gather all your information. And then once you've got everything ready to go and it's been uploaded, you can just say, you can send a message to your team. And you'll notice with Lisio, you have a specific team member. So you have a list of an account manager, account technician, and bookkeeper, if applicable. And so you'll be able to see who the people are that you can reach out to message, say, hey, I've got my file ready to go. Please log in the file. It is important to take that extra step and let us know, yes, you're good to go, because people will upload documents all throughout the year. We won't consider just the upload of a document as the trigger for a login. We are expecting some sort of email from you or Lisio message from you saying, hey, all my documents have been uploaded. Please log in the file. So I hope that answers your question. But getting back to our chart of accounts. So we do use this standard chart of accounts across our entire client base. And this allows us to do that benchmarking analysis. And it also allows us, if we're using QuickBooks Online, to leverage bank rules so that we can copy those rules from one user to another. So the chart of accounts is effectively the list of all the accounts that you're going to use across your entire general ledger, or all your income statement and balance sheet transactions. So what this effectively means is every single dollar that goes in or out of your corporation is going to have to be assigned to one of these categories. I'm not going to bore you guys with how double entry accounting works, but suffice it to say, every transaction needs to be categorized into one of these accounts from the chart of accounts. and I don't know why my slide is not changing, but there we are. So the big question is, what do you guys want to know about what you can claim as far as a deductible expense? And I'm going to do my best to give you some examples of the things that you can claim as far as deductible business expenses. But I want you to realize that this is not an exhaustive list. This is meant to be an introduction to the types of things that you could deduct and the types of things that the average IT or service-based professional is deducting. When it comes to deducting business expenses, there's a couple of really key things that you need to be aware of. Is first and foremost, it can't be specifically disallowed by the Income Tax Act. Now, the good news is there's not a lot of things that are specifically disallowed by the Income Tax Act, but there are a couple. Things like your home telephone line, golf green fees, club memberships, and life insurance are examples of things that are specifically disallowed. Now, life insurance, there's some exceptions. Talk about that in a bit. But most items fall into this gray area where they have to meet a couple of other criteria. One, they have to be reasonable, which by definition is subjective. What's reasonable to you, what's reasonable to the auditor, what's reasonable to the business next door is very subjective. And what we want you to realize is that whenever anything is subjective, this is a potential benefit to you, because as long as you've got an argument for why something should be deductible, that means you've got a defensible position. It doesn't guarantee you've got a winnable position, but it means you have a defensible position, which means even if CRA disagrees with you and they want to make you pay for the taxes on that item and not deduct it, then they can't hit you up with penalties because you have what we call a defensible position. So one, it can't be disallowed. Two, it has to be reasonable. And three, it has to have the ability to help your business earn income, which again is vague and open to interpretation. And what we want to encourage you to do is to look at your life with a new lens, a lens as an entrepreneur who looks at everything that they do in their life as potentially having an impact on their business and therefore potentially being deductible. And the objective when it comes to maximizing your expenses is not to get you to spend more money. It's to take what you are spending and make as much of that business deductible as we possibly can. And the reason is every dollar that you deduct as a business expense is a dollar that you will pay zero tax on. So the more that we can maximize those deductions, the less you will pay in total overall taxes. So with that high level overview out of the way, let's get into some of the categories. So first and foremost, you can deduct your accounting fees. So anything that you're spending with us is going to be deductible. Anything that you're going to be spending on any financial software like QuickBooks Online, Dext, any of those tools is also going to be deductible. I like to get that out of the way because if anyone's ever looking for a way to reduce their taxes, you can always pay us more. We're always happy to raise those fees if it'll make your life easier. Okay, poor accounting humor, but it is important to know that our fees are 100% deductible. You can also deduct advertising expenses. So this could be things like websites, business cards, traditional advertising, digital advertising online with Google, Bing, Facebook, all of those things. But the other thing about advertising that you might not be aware of is that if you ever host an event, that could be considering an advertising event, which is very different from business promotion, which we'll talk about later when you're just having a meal with one or two other people. But if you're having an actual event, we can claim that under advertising expenses. In addition, we can also claim gifts that we are providing to potential clients, to people that you've worked with in the past, to people who helped your business grow. Lots of things there we can claim under advertising. And in fact, it's one of the most underutilized expense categories. Next thing we've got on the table here is the automobile expense. And there's two methods here. We've got the actual expenses where you keep track of all your gas, all your repairs and maintenance, your leasing costs and or your amortization costs if you purchase the vehicle. And then we take a percentage of those costs based on the number of kilometers that you've driven. So if you drove 100,000, well, let's say 10,000 kilometers in the year, and 7,500 of them were for business, we then take 75%. So 750 divided by 7,500 divided by 10,000 gives us a percentage of 75%. And we would multiply that percentage times the actual cost that you have. However, for many people, the mileage method works out better for you. And the mileage method, I apologize about that, is a method that is calculated strictly based on the number of kilometers that you drive for business. And you just need to multiply that by the mileage rate for the year or the period that you're using. We do have built into our cred manual the mileage rates, and I can get those for you. I don't know them off the top of my head. But those are the two different methods that you can use. You can switch back and forth from year to year. So one year you can use mileage, the next year you can use actual. And this can be beneficial because in certain years, if you purchase the vehicle, you might have more amortization or depreciation on that vehicle than other years. So you might want to switch back and forth, and you can use whichever method that gets you the greatest deduction. However, you can't use one method for one vehicle and another method for another vehicle. You choose your method for that year, and we apply it universally across the vehicles that you use for your business. Now, when it comes to the automobile expense, one of the questions we do also get a lot is buy versus lease. We've got a whole blog on that, and that's a topic for another day. But what we typically say is don't let the tax tail wag the dog. Figure out what's better for your lifestyle rather than what's better for your tax. Are you the type of person who wants to have a new car every couple of years? Or are you the type of person who's going to buy a car and keep it for 15, 20 years until it doesn't drive anymore? Those decisions ultimately drive what's best for you more so than the tax implications. But one of the other tax implications to be aware of is whether you buy or lease the vehicle through the corporation's name or under your personal name. We typically recommend that you actually do it through your personal name. The advantage there is that we don't have to worry about having any taxable benefits based on your personal use of the vehicle. We also don't have to worry about any gain or loss on disposal. It becomes a lot easier from the bookkeeping standpoint. The only, well, I guess, and the only real downside is if you are going with an electric vehicle, and there are some new rules on that, there's different subsidies for whether you're buying it personally or through your corp, and there are some better subsidies if you're going through your corp. But a heads up that if you do that, there are some other implications to be aware of around these taxable benefits and the gain or loss on disposal. One other thing to note about automobile expense, it is one of the most commonly audited expense categories. And that's simply because CRA has figured out that most people don't keep a mileage log, which you are required to keep in order to claim the mileage and automobile expenses. But there's, again, new tools for that. QuickBooks Online has a mileage tracker. MileIQ is another mileage tracker that you can buy. These apps will allow you to treat your driving and you just swipe left or right, whether it's business or personal, sort of Tinder-esque style. And they go a long way for making this process a lot easier and allowing you to keep your deduction. And the automobile can turn out to be one of your larger deductions, depending on how much mileage you're putting it on. So bank charges, credit card expenses, those types of things we can claim as well. It is important to note, in order to claim the credit card fees, and some of them can be quite high. I think my fee for my Amex is $699 a year. If I want to claim those fees, it's got to be a corporate credit card. We have sometimes occasionally claimed an expense that was under a personal credit card name that was used exclusively for the business. But be aware that if you're audited, CRA might deny those because it's technically not a corporate credit card. So if you want to be claiming the fees for your credit cards under bank charges, make sure that the credit card is issued under the corporation's name. Books and periodicals. This is a great one that is becoming smaller and smaller for a lot of people. but can include things like Audible subscriptions, digital books, ebooks. And as far as we're concerned, everything that you read is part of your body of knowledge that enables you to do the job that you do. And so we are very generous in what we can claim as far as books and periodicals. And this can include newspapers, magazines, online subscriptions, audiobooks, et cetera, et cetera. Pretty straightforward category and often underutilized expense category. Business promotion, here's another great one where we can make a really big difference in the amount of tax that you'll pay, because most people underutilize their business promotion expenses, particularly if they're new to us. And as far as we're concerned, everything that you do as an entrepreneur is to help your business grow. So anytime that you go out for a meal, to network with someone, to build relationships with people, all has the ability to help your business earn income, even if you aren't specifically discussing business. And, I always used to talk about the analogy where if you sat down with a vacuum salesman, and as soon as you sat down for lunch, the first thing he did was say, "Hey, how many vacuums are you going to buy for me?" The answer would probably be no. Whereas if this was someone that you built a relationship with and you had lunch with them, once a year, anytime that you needed a vacuum or you had a friend that needed a vacuum, you're likely going to think of that person and recommend or refer them. So networking and building relationships, absolutely a legitimate part of business, and that would be deductible under business promotion. Now, the government does recognize that you're getting a personal benefit out of the meals and entertainment that you're having, and this is what we call an add back category, where you give us the amount in the full that you spent on business promotion, and on the tax return, they're going to add back 50% of that. So you only end up getting 50% of the expense deduction. What else do we have here? Computer lease expense and computer supplies, which goes hand in hand. Not many people are leasing computers anymore because they're not as expensive as they once were, although that's actually not so much true anymore with the cost of some of these MacBooks. But 100% deductible, no real issues. The one thing to be aware of is that if you are going with a purchase, even if it's a finance purchase where you're paying like one of those subscription services only $55 a month, that's not a lease. And that would be a computer purchase, and that would go under amortization. And we would take a percentage of that over time, which we'll talk about in a second when we get to amortization. But if you are leasing a computer, 100% deductible, although very few people are doing that. What most people are doing right now is doing lots of software as a service. The amount of subscriptions that we are seeing with people has dramatically skyrocketed over the years. So computer supplies expenses is quite a common category where we see quite a bit of expenses for all these SaaS services, as well as all your traditional computer supplies like peripherals, mice, keyboards, those types of things would go under computer supplies. Consulting fees. Once upon a time, we used to use consulting fees as a form of income splitting. We don't recommend that anymore. Where we are seeing the consulting fees go more and more is with subcontractors, Upwork, those types of things. So if you are bringing on any subcontractors to work with you, that would go under account 770, consulting fees. And that brings us to amortization expense, which we touched on briefly when we talked about your computer hardware. So there are certain categories: computer hardware, office furniture, heavy equipment, vehicles if they're owned by the corporation, that have a useful life that extend beyond the current reporting period. And when you have something that has a significant value that extends beyond the current period, the government basically wants us to only claim a percentage of that expense in the current period. And there are actually prescribed rates for all the different categories of assets that you might have. So the rate for a vehicle, for example, is 15% in the first year because it's got a half-year rule, and then 30% in every subsequent year. Office equipment would have a lower rate. And like I said, there's prescribed rates for every class of equipment. I think computer equipment's at 55% right now, if I'm not mistaken. But basically what happens is you take a percentage of that expense in the current year, which shows up as your amortization expense. And that reduces the balance on the balance sheet of your assets. So you would have in the first year, let's say a computer, or let's go with a, let's imagine you had an automobile for $30,000, and in the first year you take 15% of that. So in the second year, you would have what is it, 26 26,500, or sorry, 25,500 remaining, and then in the next year you take 30% of that remaining value of 25,500, and that would be expensed each subsequent year in a declining method, eventually getting down to the point where you would write off the value of that asset, because it would technically never get to zero, because you're always taking a percentage of the remaining value. So you could get to the point where you're just taking a percentage of like $1, and at which point you would just write off the remaining value. Next, we have the director's fees expense. This is, again, something that's very unique to our client base. Most of our clients do not typically do a monthly payroll. What they're usually doing is taking a loan from the corporation throughout the year to cover expenses that they pay for on behalf of the corporation. And at the end of the year, we look at how much money that they took out of the corporation that was not used for corporate expenses. And based on that, we declare a director's fee. So that's your director's advances, money you took out as a loan. And the director's fees are what we declare during your tax planning to offset those advances and bring the balance back down to zero. And those would show up here under director's fees, or potentially wages if we're doing income splitting with family members. Education and seminars is another example of things that you can claim. There is really no limit on what you can claim as far as education and seminars. And this is a great way to legitimize travel. So if you want to go down to Florida, if you can time that with a conference in Miami, like I just did last week, you can make all of that travel legitimately deductible. So education and seminars are a great thing, and they're important to constantly be working on, because if you want to stay at the top of your game and continue to earn top dollars in the consulting world, you need to be making sure that you're investing in yourself and your skill set to constantly grow and improve. Employee benefits expense. The most common thing that we are going to have here every single year is the employer portion of the CPP on any salary we declare for yourself or your employees. But you could also have things in here such as health and dental plans if you happen to have any of those. A lot of our clients will opt to go with what they call a health spending account. And that is because if you are just paying for your medical expenses as you need to, you can claim those on your personal tax return, but there's a minimum threshold that you have to be over. And then even then, you don't get to claim all of it. You have to take away the minimum threshold. So you're not able to deduct as much as if you were to deduct it through your corporation. But in order to deduct it through your corporation, you have to have a registered insurance plan. And the health spending account is the cheapest way to do that, where you typically pay an insurance provider a premium of about 10%, which enables you to be able to deduct the expenses that you incur for health and dental and all those fun things. And that would fall under the employee expenses. General expenses, a catch-all. If you don't know where something should go, it might fall under the general expense category. We do also, if you're using QuickBooks, have an Ask My Accountant section, where if you've got something and you're not sure where it goes, you can put it under Ask My Accountant, and we'll review that. So typically speaking, the general expenses should be a small category, but it's another category that is used by our clients when they have expenses and they're not sure which category it quite fits into. Insurance expense. So we did mention earlier about how life insurance was specifically disallowed. However, you can claim E&O with no issues. You can also have disability insurance. If you claim disability insurance, the benefit becomes taxable. So typically we don't recommend claiming disability insurance, but you could. In addition, there are ways to have life insurance issued to the corporation, and there are benefits of doing that. Arguably, the most important thing is something called the capital dividend, which means if you have an insurance policy under the corporation, when it pays out a benefit to the corporation, that goes into a special account called the capital dividend account, and then you can pay that capital dividend to your shareholders tax-free. So having a corporate policy can be a really effective tool. But since, as I mentioned earlier, it's specifically disallowed by the Income Tax Act, there are some other exemptions that I won't get into today as far as requirements based on the bank, but assuming for most small businesses, it's not required by the bank as a covenant, then it's specifically disallowed. But you can still claim it under the insurance expense category, but then it's added back again on the corporate tax return, much like half of the business promotion is added back. So this is another potential add back category. Interest and penalties expenses, pretty self-explanatory here. If you have any interest charges from your bank or any penalties from CRA, we would record those here. We've also got, and I don't know why these ones didn't come up one at a time, we've got your office supplies expenses. Again, an often overlooked category, because a lot of times what happens with office supplies is you'll go to Costco and you'll lump in it all together and not break out the individual things. And it's lumped in usually with personal grocery bills and then gets overlooked. I do encourage everyone to try and do a better job of separating out those items, like cleaning supplies, paper, waste paper baskets, pens, staplers, all that fun stuff that goes into running and managing an office. Because for the average IT consultant, that averages to about $800 a year, which is $800 you can avoid paying tax on if you take that extra step to track it separately. Next, we have your rent expense or home office expense. This is for most of our clients who don't typically rent a formal office space like a WeWork or a Regus or an actual dedicated office space. For most of you, this is going to be your home office. And what we can do is claim a percentage of your costs, which if you rent would just be your rent and your utilities. But if you own, it's going to be your utilities, your property tax, as well as a percentage of your mortgage interest. Not the monthly payment you make every year or every month, but the actual interest portion only. And you will get a report from your bank once a year that tells you how much you've paid in interest. And a lot of more banks, if you can go online, you can get the actual report. And what we do is we take a percentage of that based on the square footage that you're using for office space. So again, much like the automobile, we're gonna use a numerator and a denominator to figure out a percentage. The numerator is going to be the square footage of the actual office plus the garage, assuming the vehicle is used for business. And then for the denominator, we'll take the total plus the garage, since we use that in the numerator. We'll remove the common areas like the kitchens, the hallways, and the bathrooms. And for the average person, we'll get an expense percentage of around 20 to 25%. You can also use a number of rooms method as opposed to the square footage method. And the number of rooms just says, well, if my house has 5 rooms and I have 1 room for business, then it's 20% business use. So pretty straightforward. And again, arguably one of the largest expense deductions over and above your salary that you'll have in your business. So telephone is another one, which can also include telephone and internet. Now, as you noted earlier in the beginning of the session, I said that your home telephone is specifically disallowed, but cell phones, long distance, secondary lines, those are all deductible, but the base home telephone line, if you still have a landline, is specifically disallowed. Next, we're on to professional fees, which could include lawyers or other professionals that you might be getting advice from. Not typically your accounting fees, those go under accounting fees, but other professional services that you would be using. Then we're into the last couple here, which is travel expenses. And again, we want to try and make as much of your personal travel deductible, business-related travel, by looking at combining it with conferences, which is a great way to do it and probably the most traceable. But also other ways like looking at foreign properties for investment, et cetera, et cetera. It looks like we've got a couple more questions that have come in through here. Oh yeah, sorry, I skipped over repairs and maintenance. Thank you for catching that. And so account 880 repairs and maintenance is typically meant for repairs and maintenance specific to your office area. So typically, if you have repairs and maintenance to the whole home, like let's say you redid the roof. If you redid the roof, then that would go as part of the rent expense, and we would take a percentage of that. So we would take 25%, assuming that 25% was your home office use of the cost to do the repairs and maintenance of the roof. Whereas if you actually did something like, let's say that you hired someone to come in and paint the actual office space. So if it was something specific to the office area, we would claim that under repairs and maintenance, or we would be claiming 100% of that as opposed to the percentage that we used for the home office percentage. So thank you for catching that. And then, so can I deduct my cell phone cost if the bill is in my name, pardon me, or my spouse's name? Yes, in either or. It is always better to the more clear and direct we can be. Yes, we would love to see the cell phone be under the corporation's name. But there's lots of situations where you can have expenses that you're paying for those expenses, and then the corporation is reimbursing you for that business expense. So who is paying for it doesn't change the criteria for whether it's deductible, right? What that simply does is just lends more credibility to the likelihood that this is a reasonable business expense that will help your business. So it provides an extra layer of documentation, but is not necessarily required to be under the corporation's name in order for the corporation to expense that. If I renovate my home office to include built-in cabinets and purchase a new desk, couch, and chair, is that all business expenses? Yes and no. I mean, and it's all probably business expenses, but you're probably not going to claim all of it in certainly the first year, because the home office, the renovation, there's some subjectivity there. If it was dedicated space, we would claim 100% of it. If it's part of a bigger project, maybe we're only claiming 25% of the whole renovation costs. And so yes, but what percentage, I'm not sure. And then with things like the new desk, couch, chair, those would be office furniture, which we would amortize, and then we would take a percentage of those based on the office furniture rules. But yes, you can claim those as business expenses. They're coming through fast now, fast and furious, which is okay because we're nearing the end of the list. Can you deduct cleaning services? Yes, if they are cleaning your office space, right? Again, if they're doing something where they're cleaning the whole home, what we would do is likely, which assuming it includes the office space as well, we would take a percentage of that, just like we're taking a percentage of the utilities. Okay, so where did I leave off? Travel expenses we covered. Wages and salaries, which is typically the additional wages to either family members or arm's length individuals other than the directors of the corporation. We do also have a category for non-deductible lifestyle expenses. We used to be very big advocates for keeping track of every dollar that you spend, certainly from a budgeting standpoint and stuff like that. In QuickBooks Online, we sort of discourage that now because it just became a giant mess. But to the extent that you can keep track of all the non-deductible lifestyle expenses and better understand where your money is going, you might often find that there are things in there that you could actually claim as business expenses. But the non-deductible lifestyle expenses aren't ones we are going to claim as business expenses, but it's meant to be a catch-all for all the things that you're spending money on so that you can keep track of where your money is going. Next, we're going to touch on the assets. Hopefully. Okay. So we've got the capital assets that, as we mentioned earlier, are going to depreciate over time, and that we will take a percentage of those expenses. And these will sit on your balance sheet, not on your income statement. What will show up on your income statement is the percentage we're claiming in the given year of those assets. So the assets could include automobile. If you have purchased an automobile through the vehicle, it could include computer equipment, computer software, office equipment, and office furniture. So those are the major categories of capital assets. Again, not an exhaustive list, just the ones most often used by our client base. And so what you want to do is in your first year, sort of prepare a list of any of the assets that you might have had pre-existing, because those can be transferred in at their fair market value. So not at the price that you paid for them, but their fair market value. And then, of course, any new purchases that you've made throughout the year. But if you're brand new to independent contracting, you can potentially bring in any assets that you owned prior to starting this business. So if you purchase meals while traveling, does that fit under business promotion or travel expense? It would go under business promotion. Back in the day, you used to be able to claim meals while travel at 100%. They changed the rules on that. So you do now have to claim all meals, even if they were while traveling, under business promotion, which gets added back at 50%. The one thing to note is that typically for meals and entertainment, to be qualified as business expenses, normally you have to be having the meal with another individual. You don't have to be necessarily paying for that individual's meal, but you can't be eating, because it's business promotion, right? You're networking, building relationships. You have to be eating with another individual in order to claim it. You can't just be like, well, I ordered pizza so I could work late. I'm claiming that as business expense. No. But if you are having a meal while traveling, then you can claim that even if you were eating that by yourself. Another question here. Should I transfer, sell my personal computer desk or other assets that I use for business to my business and depreciate, deduct the expenses there? Yes, effectively, yes. So if you had any, they don't necessarily have to be, they should be listed as assets on the balance sheet of the corporation, right? Like there's not normally a purchase agreement for a computer or a desk or asset. But if you are setting up your business for the very first time and you already have a computer or a chair, yes, we should be transferring in those at their market value at the date that you started your business. And then we could take a percentage of those and depreciate them over time. Okay. So we used to have a big pitch in here for Receipt Bank, which is a great product. Unfortunately, they did hit us really hard over the head with a price increase of over 500%. And so we are no longer offering that product for free anymore. I will still recommend leveraging technology where and when you can and looking at it. It's normally about, I think its starting point is $30 a month. We get a discount over that, so it's only $25 a month if you buy through us, and you also get more uploads. So like their starting point is $30, but limited to only 250 transactions. There's no limit with us, and it's a little bit cheaper. But unfortunately, there is now a price for leveraging tools like Dext. What Dext is a mobile app, well, and a web-based app as well. It allows you to snap pictures of your receipts, and then those receipts are available for download in either Excel or linked over to QuickBooks Online or Xero. So a couple more questions that are coming in here. Great question. Are business meals on weekends, nights less credible? Less credible, yes. Less deductible, no. I remember going through an audit where an auditor tried to say to us, hey, this meal was on the weekend, it's not deductible. We're like, no business in this world operates 9 to 5 anymore. And we were successful in defending that position. But yeah, we got challenged on it because the CRA tried to say, hey, this isn't a business expense. It didn't happen during business hours. No, that they may try to use that argument. They can't win it. I know firsthand because we won our case in that situation. In my first few months of running my business, I did not keep track of my receipts. The expense only shows up on my credit card. Can I still deduct it? Another great question. So Yes, you can still deduct it, but if you ever get audited and you cannot produce the receipt, CRA can deny it. So when we're preparing your income statement and balance sheet and filing your tax return, I don't ask you for receipts. I'm expecting you to be able to go back and, in the event of an audit, be able to produce those. But you can claim those expenses, and should you get audited, you'd be prepared to provide them. Now, there are situations. There was a really well-known case with a gentleman who'd gone through a divorce, and during those divorce process, his wife had taken all his belongings and lit them on fire on the lawn. And the judge gave him, which included his tax documents, the judge gave him 50% of everything he claimed just based on his word, not even based off of credit card statements. So there is some ability to demonstrate that you have spent money over and above a credit card receipt, or over and above the actual receipt. However, it's important to note that the courts have long held that a credit card statement is not a receipt. It is not valid supporting documentation. But depending upon your auditor, depending upon your judge, they may give you a percentage of those if that's all you do have. I spent a lot of money to set up my business before I incorporated. Can I deduct that? And how far back can I claim? Yes, you can claim expenses you used to set up your business. There is not the Income Tax Act doesn't say you can deduct it up to 3 months, 4 months, 5 months, 6 months. But it has to be reasonable. And generally speaking, we use as a guideline typically about 3 months. But yes, if you have spent money to set up your business prior to the date of incorporation, you can claim those expenses. What's the alternative to using Dext? So the free alternative to using Dext is to at least take a picture of your receipts using your mobile phone, right? It doesn't have OCR and the ability to create an Excel spreadsheet for you. But at least if you ever go through an audit, you can go back and locate those receipts. Maybe if you go through an audit, you can take everything that you've all these pictures and load them into an OCR software at that time and only pay for 1 month of service. If you're looking at it from a documentation standpoint, there are other alternatives. HubDoc has got another alternative. Expensify is another alternative. There's a couple of other apps out there that do the same thing. They all are generally around the same price point, unfortunately. It was very, very rare that we used to have this unlimited license deal that we had with them, which unfortunately they have since taken away from us. I'm in IT, but I do photography as a hobby, and I'm thinking of doing photography as a business on the side. Is that allowed? Can I deduct all my photography equipment? Yes. So you are not limited to only doing IT consulting. That is just the primary. When we file a tax return, we have to say the primary source of income, but you're not limited to that category. However, if the CRA sees that you tend to have all these expenses for photography and you never generate any income from it, they may claim that that's a hobby and not a business, and therefore not deductible. So you have to keep an eye on that. But certainly you can do that, and if you are generating income, you can earn that income through your business that you do IT consulting with as well. What about just using QBO for receipts? So yeah, QBO does have a receipts feature built into it. It's not very good. We have been pushing them really hard to get it cleaned up and working. It's a way to link individual receipts to a transaction, but it's not the same way. It doesn't work quite as well as like just taking a whole bunch of pictures and uploading it and then OCRing it and doing the category and all that fun stuff for you. So it's definitely a poor man's version of Dext. So you could use it, probably a step above using just your phone if you already have a license for QBO. But I'm not sure if I would go with QBO just to get the receipts feature. It's not quite as good as Dext. But you can use it, yes. I was thinking of having my kids help me to scan and organize my receipts and help with my social media. Can I pay them a salary for that? What is a reasonable salary that can be given? Yes, you can. I mean, obviously, outside some child labor laws, we have minimum ages that we have to pay children. So starting point is usually at least 14. But yes, you can pay them a reasonable salary. What is a reasonable salary? It depends on the amount of work that they're doing. Typically, you want to pay them somewhere around $14,000 a year. That's because that is the top end of the basic provincial exemption and federal exemption. So you'd pay very little tax to about $14,000. Anything more than that, obviously, we're going to have to require more involvement in the business. Similar question to the photographer. If I'm building a product and getting prototypes, if I'm building a product and getting prototypes, but consulting full-time, how do I prove sales if that may be a longer term goal? So yeah, this is like sort of like a tech startup where you've got to invest a lot of money up front to long before you'll ever generate a dime of revenue. So yes, so what I should say is, just because you're not generating revenue doesn't mean it's not a legitimate business. It just means the CRA may ask you to prove that you have a realistic opportunity for profit. So if they come along and you can prove this is why I'm spending the money, this is why I believe I have a realistic opportunity for profit, you can claim those expenses. I have an assistant who lives in India. They give me an invoice. But do I need to have a contract for CRA audit purposes? You probably don't need to have a contract for CRA audit purposes, but you should have a contract for business purposes. And you've got to be careful. Having a really solid contract is important, period. Not necessarily from a tax perspective, but from a business perspective. CRA is not typically going to want to see a contract. What they're going to want to see is an invoice. Now, if that contractor were here in Canada, you definitely want to make sure you have a contract, because the risk could be deemed that they're an employee rather than an independent contractor. And contract's one way to solve that, or help put a layer of protection. I think from the slide deck, that brings us to the end. I think that brings us to the end of our presentation. Yeah, just where to get more information. So we do have our Facebook group, the Self-Employed Support Network. You can find more events that we offer all throughout the year under cpa4it.ca/events. We've got our free resources available on ShareFile. The CRA's got a great website. We also have the new chatbot. We also have launched a new, for anyone who's interested in AI and technology, I'm launching a new, called a Labcast. It's not a podcast. It's more like a Labcast where we go live every Friday, looking at various pieces of AI-based technology and showing how you can implement it in your business. Last week, I took the week off because I was in Miami, but the week before that, we looked at Canva. This week, we're looking at ChatGPT. Each week, we'll be going through a new AI technology. So a few more questions that have popped in. I work from home, but for 3 months, I was in Dominican Republic working remotely. What expenses on that trip can I deduct? So you could probably claim a place to work, like a home office, a percentage of your living costs while you're there. I'm assuming you weren't staying in a hotel, that you were renting a place. You could save a percentage of that. Depending upon why you were in DR, you could potentially claim your travel. You could look at other things. It depends a lot on the individual specifics of your situation. If you just happen to be working remotely, that doesn't make the travel to that remote location deductible, right? And there has to have been a business reason for you to go there. Now, you could, like I said, at the very least claim a percentage of the place that you were staying for essentially like a home office. Can we get a full list of your chart of accounts? Absolutely. What I'll do is I'll get Rachel from our team to send an email out to everyone with a list of our chart of accounts, which is available in an Excel format that is downloadable and as well importable into QBO if you are using that. In addition to the chart of accounts, we also have our CRED manual for anyone who is going to be using Excel to do their accounting and bookkeeping. Our CRED manual is just an Excel spreadsheet that we use very regularly. We've been using it for decades. It's not necessarily the best Excel pivot table or Excel table in the world, but it's one that we have years of experience with, which gives us efficiency. So if you're going to be doing that, if you're going to be using Excel, that's the version of Excel to use, not the version you've created, which might be better for you, but will probably cost you more in accounting fees at the end of the year. Okay, and that's it. This was great. Glad to hear it was an informative session. Thank you for joining. Can you please also send the CRED file to me for home office expenses? Yeah, we can do that. So I'll get Rachel to send a copy of the CRED and our chart of accounts. And a link to, for those of you who aren't familiar, we do have on our website, if you go to CPA4IT/expenses, you'll find most of these expense categories with a brief description that what we've covered here today. Excellent. I think that's a wrap. So I will give you guys back a bit more of your time. And thank you for joining me today. And have a great Tuesday. And happy Halloween, by the way. Yeah. I should have worn a costume. That's what I should have done. Okay. Thanks, everybody. Bye for now.